Welcome back. You're still with Power Lunch here on NDTV Profit, and our focus is now on the budget and with the markets in good form. We're very pleased to welcome Kalpesh Maroo, partner BMR and Associates, in our Bangalore studio. Thank you very much, Mr. Maroo, for joining us once again on NDTV Profit. I'll get right to it. We'll start with the infrastructure space, and I could run through a whole host of things that seem to have come through, which are positives for the infrastructure sector, starting with, of course, this, the policy piece of it. Can you pick out of the policy initiatives for the infrastructure space, which is the most significant and why?
Afternoon, Manvi. I think, like you rightly said, there are a whole host of changes that have come through. On the policy side, I think what is the most encouraging or two most encouraging pieces of policy initiatives that have been announced. One, I think, is transformational. It is a policy announcement, and we'll obviously wait to see the fine print and the actual bill to be put in place. But this is a proposal of the government which recognizes the fact that infrastructure projects by definition are sort of long projects where the payback period is significantly longer, and several variables on the ground can change as compared to the point of time when the bidding for the project happened. So one of the changes that is being proposed is an institutional framework for actually renegotiating the terms of the concession agreement based on an overall framework. Essentially, I think what the government is trying to say is that if a project was awarded on the basis of, let's say, 5 basic assumptions, including economic activity, ridership survey, as the case may be, and if the ground realities actually change, then there should be some room that is available and left open to be able to change the terms of the concession agreement. This is a hugely positive move. It, of course, needs to be balanced to ensure that transparency is not compromised, because any situation where a concessioner, after the contract has been awarded, ends up getting a favorable change in terms is going to raise question marks. So as long as when the lawmakers draft the bill, they are able to come up with an institutional framework which is transparent, clear, and addresses this significant concern, I think this is a really big and a game-changing move. The second one has been spoken about a few times prior to the budget announcement as well, and this is a framework for dispute resolution. As you are aware, a lot of projects across the country, and particularly in the road sector, are stuck with a myriad set of issues on different kinds of disputes on different points of time. Often the government is one of the parties to the litigation, and I think the proposal that has come up is setting up a framework for timely resolution of disputes. Both of these changes, if you think about it, take away uncertainty from investment decisions. As long as these policies are written out in a clear way, this will go a long way in addressing some significant concerns for infrastructure developers.
As long as the policies are written in a clear way. Well, fingers crossed on that front. But I want to address two other aspects of the policy piece for infrastructure. One is this new credit rating system for infrastructure projects, and the other is the talk of, credit enhancement via the LIC funds approach for the infrastructure sector. Just contextualize both those, particularly the one on the new credit rating system. How important is it?
Can't be overemphasized. As we know, infrastructure sector as such is extremely capital intensive and currently realizes extensively on the financial support and the cost of funds that come in, which are largely supported today by Indian banks and financial institutions. Any move which is aimed at reducing the cost of borrowing for these projects is extremely welcome, and both of these changes go in that direction in terms of credit enhancements, credit ratings. Really big changes. When we talk about the tax part of it, I think there are one or two loopholes which have been sort of left out. But I think if you look at the thrust of the entire budget and many of the changes that have been proposed, I think they recognize the need for bringing in funds into this particular sector, and the government seems to be doing everything that it can within its powers to free up the flow of capital to the sector, whether it's changes on the InvIT regime or the credit enhancement that we just spoke about.
You know, I just wanted to flesh out the moves on the InvIT front, although I have to say I'm sure many of our viewers are wondering what is this new phrase that is certainly the flavor of the, the week or the month. But explain to us InvITs and the move on by the government, which essentially rationalizes taxes on InvITs, and why it's significant.
Okay, so if you look at it conceptually, what is an InvIT? InvIT is a trust or an investment vehicle which over a period of time will own completed infrastructure projects which have a steady, predictable cash flow. And why is this important? As an asset class, again, we've spoken about the fact that infrastructure is capital intensive. We need an institutional mechanism where there is a clear market for infrastructure developers to, once an asset is developed, for that to be sold into a different vehicle where investors with a different risk appetite who are looking for more predictable cash flows invest into these vehicles and therefore buy into the infrastructure piece in the country. So as a vehicle, InvITs are very important because they provide exit to infrastructure developers, help banks to take loans off their balance sheet, help a different class of investors to put money in them. The policy on InvITs, like in the case of REITs, has been evolving over a period of time on the taxation front. The last hurdle that was required was for the clarification or the amendment that has been proposed and that has come through. Essentially, think about InvIT as a trust, which is a collective pool of money from different investors. That pool of money is thereafter used to either buy an infrastructure asset, whether it's a road or a power plant. Now that asset can be bought directly into the InvIT or the trust vehicle itself, or you could simply buy the shares of the company that owns the asset. The government, in its wisdom, has chosen the latter manner as the preferred option for InvITs to hold shares because they give capital gains exemption to developers for transfer of their shares in the InvIT. With that being the case, the fact that the asset was held by a corporate entity below the trust was creating an artificial tax cost in the form of dividend, and that has been taken away. So as the rules now apply, any profit that is earned at the SPV level that owns the asset can be distributed back to the InvIT, which in turn can be distributed back to the investor completely tax-free. I mean, this is a game changer, and you will see a lot of action happening in this space.
Right. Well, Mr. Maroo, just hold on because we're going to take a very quick break and then we're going to discuss the moves on the real estate side. REITs, there are, comparable sort of moves that have happened on the REITs front, like we've discussed InvITs, but there's a lot of other, positive measures in the budget for the real estate space, for one. We'll discuss that with Kalpesh Maroo after a quick break.